The Crotchety Old Men podcast is not a registered investment, legal, or tax advisor or a broker-dealer. All investment financial opinions expressed by or on the Crotchety Old Men podcast are from the personal research and experience of the owner of the site and are intended as educational material. Although best efforts are made to ensure that all information is accurate and up to date, occasionally unintended errors and misprints may occur. Before you invest or make any investment-based decisions, consider your own personal circumstances. You should do your own research and seek advice from a financial professional.
Good day, everyone. It's Gary Smith here with the Crotchety Old Men podcast for another episode here. Joining me in the studio today is my good man, George Crumley. George Crumley, before I go any further, I guess I should tell people what I do, right?
Who am I?
Who am I? Right. Well, I'm Gary Smith. As I said, I'm a retired commercial investment advisor and enjoying life as a retiree. George, you can tell them about yourself.
Thanks, Gary. It's a great day, and like I said, anytime I can get up and share some information, it's always worthwhile. I am retired as well, investor, real estate, big component of saving and preparing for the future, and really important that we pass this wisdom on over to those that are willing to listen. I think because, like I said before, this information does us no good because we've kind of lived through this part of our lives, and we're at a point where we're just enjoying life. So it's important that we can pass on. So hence our topic for today. Life insurance. We're going to talk a little bit about life insurance. Life insurance kind of gets mixed up. Some people think it's an investment. Some people think it's something necessary. Some people think it's not necessary. So I thought we kind of talk about some myths of life insurance, since that's something that you've actually sold in your previous lifetimes. You have that skill set of life insurance. So let's dig into it. What do you think?
Oh, absolutely. I think there couldn't be a better topic, George. To your point, there's so many misinformation, misnomers about life insurance that let's see if we can clear that up today, hopefully. Let's talk about, first of all, what is life insurance? And life insurance, having sold it for a number of years, is the foundation. It's like the insurance if you got a goose that lays golden eggs, what do you insure, the goose or the golden eggs? Well, obviously you insure the goose because that's what's making the golden eggs. Well, insurance operates somewhat the same way. You hear a lot of people say, well, it's a gamble with the insurance company that you're going to live to a certain age and they're betting that you're going to die. Well, that's true. It is what it is. But depending upon certain stages of life that you're in, there's also certain stages of life insurance. There's one which most of us are familiar with, term insurance. Term insurance means just that. It's temporary. We're most common or familiar with term insurance on our jobs. Usually a job, you go to work for somebody, they'll give you X amount of dollars. Sometimes it's equal your salary or a flat rate of $10,000, what have you. Well, depending upon your age, that's a great situation, especially kids starting out. And getting your job because you got your term insurance. If you're a young family and sometimes money is tight, particularly if you're adding kids and stuff to that equation. And so, but if you're the major breadwinner, it behooves you to have some insurance, okay? Because you're that goose that's producing the golden eggs, right? So it works for that. And again, it's temporary until such time that you either make more income or you reduce expenses, whereas that you're able to afford more insurance or start converting that to what we call next is whole life. And whole life insurance means just what it says too. It lasts you the whole of your life, your entire life. So whereas term insurance is temporary and it tends to be less expensive early on in age, it's like renting the insurance. You're renting it, but it's just like rents go today. As time goes on, those rent payments go up. Whereas with whole life insurance, it lasts you your whole of your life. More importantly, you have what's called a fixed premium, a fixed amount of premium that you pay every month or every year, every quarter, however you choose to pay it. But one thing's for sure is that you can budget this type of insurance in your budget. You know exactly how much your insurance is going to cost you, whether you get it at age 25 or you now age 85. It's not going to change. And then other insurance, what I like to look at is somewhat of an investment type of insurance, George, is what's known as variable life. Or you hear some people now, they have so many hybrids of that. You have universal life or variable universal life. Typically, they mean somewhat of the same thing. There's like a hybrid. You have a portion of it is like term insurance. The insurance has a minimum, but it can go up and it can come down, but not below a certain minimum. And then the other part of this insurance has what I call an investment portion to it. And whereas that you can invest in a portion of your funds or premium into a mutual fund. And where that way gives you access to some stocks, bonds, stuff like that. So there we have it, the three types of insurance: term, whole life, variable life, or some hybrid of variable universal life.
Great. Let's kind of dissect them a little bit. Let's start talking about term first. One of the slogans is invest in, buy term and invest the difference. That's one that you hear a lot about. Understanding that term, like you say, is just that. It's temporary insurance. And one of the things that you want to make sure, even if it's through your job, especially if it's through your job, is it portable? Meaning that if you lose that job or quit that job, can you take it with you? The other thing you want to keep in mind with term insurance is the fact that it's for a certain term. It's usually like 30 years. So you have to understand that once you get to that age of 65, 75, that insurance may expire. So that means all the premiums you put into it are no longer, there's no cash value. So that goes away. Plus, you have to take into consideration are you insurable?
There you go.
Because at that age, you're older, you've had different types of ailments, because obviously nobody has perfect health. So those are a couple of things that you want to consider when you have term insurance, is the fact that it is for a certain term. So let me ask you a question. Do you suggest, if you have term, that at some point you convert it to one of the other plans that you've talked about? Or is that something that you just kind of let it live out the life and you just kind of go as it is?
No, certainly I would highly recommend that if you have term insurance, you pay particular attention to the schedule. Term insurance increases in premium typically every 5 years. There's a 5-year ban on it. Case in point, I had a term insurance policy pretty much I'd forgotten about because it's automatically deducted out of an account I had, and had it for years. I got a notice a few months ago that the insurance had expired because I'd reached, had to be last year. The insurance had expired because I reached age 70.
Really?
Yes, yes.
Wow.
And the premiums were about to go up, which I'm glad it did because they were going up to, I think, 96 or 100 some odd dollars. Where that bad boy started, I don't know. It had to be started about maybe 15, 20 bucks.
That's funny. They make it almost prohibitive for you to keep it. They raise the premium so much.
Yeah, yeah. So it becomes prohibitive. So surely, had in my younger ages, I probably should have. Not probably. I should know. I should have. I should have go ahead and gone on and converted that portion of insurance into some permanent insurance and been done with it. So to your point, is that buying term insurance, investing the difference. That's a good theory, ideology, but rarely does it work.
Mm-hmm.
Rarely do people invest the difference.
Mm-hmm.
And when you do invest the difference, what are you investing it in?
Mm-hmm.
See, so there becomes right there some confusion. Now, if you invest in educating yourself about investments and things of that nature, and probably listen to the Crotchety Old Men podcast previous episodes, hint, hint.
Shameless plug.
Yeah, then you would have heard about there's some alternative things that you can invest in safely, as well as have some control over it and make a modest amount of income on it, right? So, yeah. So unless you've done that, and buying term and investing the difference nowadays is like, it's like buying term and going to get a lottery ticket.
Mm-hmm.
There's so much volatility and stuff out there now that, it makes it somewhat challenging, but hey, you got Bitcoin and stuff like that. So, hey, what better way to, take a risk on some things that could happen, to have a tremendous return or higher return.
So, okay, switching gears, let's talk about whole life. That's one of the alternatives that you would actually convert it to So, what are some of the ups and downs of whole life?
Well, her whole life, in my opinion, shows maturity, and I use that word sincerely because in the event when you're looking to even purchase a home or you're looking to expand or borrow money or what have you, it shows a sign of maturity because now you have not only a permanent insurance where that if I'm a lender or if I'm someone looking to give you financing or what have you, and I say, you fill out your bank statement and you show your collateral and show your liabilities and your assets. Well, whole life insurance could be used as an asset because number one, it has accumulated cash value in it, cash value that can be liquidated quickly, you know. And so from that end, it has a liquidity factor that is very accessible. If you needed some money for an emergency or an opportunity, okay, you can dip into your whole life policy, take a loan out against it. Now you're taking money out tax free, and then you can take care or address whatever emergency it is, or take advantage of an opportunity to invest in something. And we can get more into that as far as the utilizations of whole life. But for that reason, and for that component of whole life, from my perspective, I look at that as somewhat of an investment. Um, Look at it as an investment that's not tied to any market. You know, that insurance is going to be there regardless. As long as you keep paying the payments on that whole life insurance, it's going to stay there. The death benefit is level. Okay. The dividends that are payable are predetermined. But more importantly, there's a floor. And most whole life insurances pay now anywhere from 2, maybe 4%. Now, yeah, that may not be a whole heck of a lot of money. You're not going to get rich buying a whole life insurance, but you won't go broke either.
Interesting. So you mentioned being able to borrow off of the whole life policy. So if you borrow, do you have to pay it back?
Well, you should, but you don't have to. You
Mm,
know, and people take this, and particularly black people, we take it. Well, you don't have to pay it back, and so we don't. And that's
mm,
the big. It's like taking a pistol and shooting yourself in the foot. That's
mm,
the worst thing to do is not pay
mm,
it back because when you pay it back, not only are you putting your money back to make more interest, but you're paying yourself the interest.
mm,
So you're compounding interest. You're making interest on the money in your policy, and you're making money on the money that you're putting back into it.
mm,
So
mm,
yes, I encourage people to pay that money back. That's the way. Came from a book called Infinity Investing.
mm,
Where now you're paying yourself back this money, and you're paying yourself the interest on it. And now all you
mm,
can do, and as that continue to grow, you're paying interest. I mean, you're earning interest on top of interest. That's compounded interest all day, and you got the death benefit that insures that whole portfolio.
mm,
You
mm.
can see readily where we go with this, George. That in a matter of 5, 10, maybe 15 years, with that type of accumulation, you can invest in other things, buy companies, do whatever, or you can just leave it for your kids.
Right. You kind of touched on that infinity banking, but before we get into that, let's talk about my favorite type of insurance. It's the variable life, and the reason I say it's my favorite because it basically introduced me into the world of investing and building wealth, building income. Because my brother sold me a policy probably when I was about 21, 22 years old. My first job, I didn't know what the heck I was buying, but it just paid for itself many, many times and allowing myself to, like I say, borrow money from it to see the growth of it, and then able to use it even up to this day. So let's talk a little bit about variable or what you might call universal life.
Absolutely. Because of his tutelage and mentorship, I became somewhat of an expert with variable life insurance in terms of the many utilizations of it. And number one, and first and foremost, of course, we know the insurance is there, but like you said, it's a great introduction to investing because now usually the only reason that you diversify your investments anyway because you don't know what you're doing. I mean, so it spreads out the risk. Once you identify what works for you, you know what you like, you know what you're most comfortable with, and you're most profitable with, then you get rid of a diversification. And you do like Warren Buffett and the experts in this game called finance, and then you put all that eggs in one basket, and you watch the heck out of that basket. But until you get to that point in your investment career, universal or variable life is by far the number one investment or life insurance that one should get. And here's why. The insurance the premium that goes toward insurance is based on what they call a PS58 table, and that is very, very minuscule. It's almost like the same cost of term insurance, but it's a permanent type life insurance. But here's the variability of it. You're not locked into a fixed premium. One month you can put $100 a month into it. Next month you put 50. Another month, hey, you may want to put $250 into it. Next month you may want to put another 100, or matter of fact, some months you can skip some payments as you get onto it. I don't advise that. But my point is that just like it's variable, you can take what's known as dollar cost averaging. And as we've explained again in some previous episodes, what dollar cost averaging is, and that is every time you pay a premium for your insurance premium, you're buying stocks. Some of them you're buying at a low margin, some of them you're buying a little higher, but it all averages out, and you end up making even more money. And so now you have an opportunity based upon your knowledge and your goal. You can either put some of your premium in an aggressive account. You can put some in a little less aggressive account. You can put some in a core account, or you can put some in a guaranteed account. And again, you got all that diversification there. Puts the odds in your favor of winning this game called investing. And so, like yourself, George, I'm a strong proponent of variable life insurance.
So let's talk about sizing. We've talked about three different types of programs: term, whole life, and then variable. And I'll clump that with universal. So how do I know which is best for me? I mean, that's
Okay.
a pretty broad general question, but I mean, that's, I think, is the key. What do I really need?
Well, let's take a look at it now. There's this book called I think it was Acres of Diamonds.
I remember that
That
book.
used to
Yeah.
talk about. Yeah. And so you're going to be glad. Insurance is like this. You need to get as much of it as you can afford right now, particularly if you're 35 or under. 35 or under. I say get as much as you possibly can afford right now because of your insurability. Life is not guaranteed, and more importantly, our health is not guaranteed. And particularly when we're younger, we think we're going to live forever. We have all this energy, da 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 da. We're reckless, and we do all these sort of things. But it's cheaper. Life insurance is cheapest when you're young, and so just as soon as a birth certificate, all you have to do is be 6 months old. Parents, I'm talking to y'all now, grandparents. If you want the best, one of the most precious gifts that you can give to a newborn child is a life insurance policy. That child, 18 years, 20 years go by, and you put particularly a variable policy, where you can vary the amount of premiums that you put into it. There's some grandparents out there that play the numbers, hit a lottery, or work a second job, what have you. But if you can put some money into this child, by the time that child, he or she is 18, 19, or whatever years old, getting ready to go to college. Okay, yeah, well, all our children, they look for scholarships and stuff like this, but here's a scholarship right there. Okay, you can accumulate and be self-sufficient and self-fund a scholarship, a part of that. So that's one of the most salient things when I look at the variable insurance and from the investment perspective, that it's all age dependent. Over 35, say 35 to your working age or before retirement, then I would say highly recommend is converting some of that term insurance that you may have bought when you were younger because you had a family growing, you maybe needed that $200,000-300,000. I mean, $1 million. First of all, I advise families to get $1 million policies, okay, because it's time out for black people passing along burial money. Those days are gone. All right, we need to get these bigger policies, y'all, so that the next generation will have something to stand upon and a start rather than from always start from scratch. All right, that's another podcast. But in wrapping up here on your question, George, the older we get, of course, our longevity changes, our health changes. So that's the importance of locking in that insurability early on. Because even if you find out that, let's say, for instance, you got diabetes type 2, there's younger people getting this diabetes a lot sooner nowadays than it used to be when we were young. Okay, so your health condition can change just like, well, that diabetes type 2 could change your rating and cost you more premium dollars to go more toward insurance than again toward investment. But if you got this term already and you convert some of that term based upon what your affordability to whole life, whether you got type 2 diabetes or not, they must give you that insurance. And that's big. Okay. So your cumulative years, like your working years, you got that whole life insurance. Now you got a nest egg. A lot of people work for somebody else for most of their careers. Nothing wrong with that. But all of us have a dream of someday either owning our own business or doing investing in real estate or what have you. Here's your nest egg. Here's your seed money. You don't have to go to a bank because most banks are not going to loan you any money if you're new to the game or you don't have any collateral or whatever. So here it is. They'll loan you money after you get it. But here's your money, your nest egg, in your life insurance policy. Last but certainly not least, from a retirement perspective, when we're old like ourselves, we want to leave stuff to our grandkids. And we want to leave them to the most tax advantaged way. Life insurance is one of the most tax advantaged way of leaving state inheritances and stuff to our loved ones. So there are the three stages: 0 to 35, term insurance; 35 to 65, whole life or variable, depending upon your situation there. And then from 65 on to your golden years, man, you're using that money either for your grandkids or dream vacation or whatever.
Hmm. Good. All right. Well, so let's sum all this up. One of the things that people talk about, and you kind of hit upon it, was borrowing against the policy. Some people call it is it infinite banking.
Mm-hmm.
Um, First of all, let me ask you this question: in your opinion, this is just an opinion of Crotchety Old Men, is it a scam?
Is the idea of infinity banking a scam or life
Mm.
insurance?
No, infinity banking.
Oh, absolutely not. I don't see how anyone could even come up with that ideology. No, I mean, no, I don't see. No, not in my
No,
opinion.
I didn't either. I just want to. That's one of the things I've heard. I just wanted
Yeah.
to clear that up for our audience, just to make sure. But I think one of the things that here goes back to purposeful investing and purposeful borrowing. It's a program that's out there. It's based on your accumulations, and any borrowing that you do is based on your need. It's not just something you just handle wholeheartedly. So yeah, it takes a lot of discipline to do things like this.
A quick example, a deal was brought to me by another investment friend of mine. This lady owns a daycare center. She rents a daycare center. No, she rents she's a nurse, something like that. So she rents she's a nurse practitioner, and she rents this space out in this building. And the owner is ready to sell the building. This lady's been here for 10 years, so she's been very successful, very profitable there. And so he wants to sell the building in the next 60 to 90 days or whatever. And so traditional lending would not would preclude her from being able to buy this property because it may have a little challenge there in the credit report, because of the pandemic, may have missed a payment or two there. Stuff happens, right? So, but she only needs about $150,000 to put with what she has to go ahead and buy the building. Well, here's a good opportunity for someone. Let's say if you got $100,000 or what have you in a life insurance policy that's accumulated. That insurance policy, let's say it's, for instance, paying you 2% and it charges you 4% to borrow it out of your policy. Okay, stick with me. So the 4%, it only costs you 4% to take this money out of your insurance policy. But you loan it to this lady and charge her 10% because she can't get money from a bank right now. Now, once she's able to get it from the bank, she can pay less in interest. But right now, it's not about the cost of money, it's about access of money that this lady really needs right now. So you loan her this money for 10%. So what's your basis of getting that money back? The collateral is the property that she's buying. So just like a bank, you're first in the first lien position. So she can't do anything with that property without paying you off first. And if she can't pay you, you foreclose and you sell the property. Property's located in a good area. She's been there for a while, so chances are she's not going. That's her livelihood. So you loan this money to this lady, and this lady pays you back. Let's say you give her 6 months to do it. She's able to do it in 90 days. 10% is what you're charging for that 100,000. You just made $10,000 in interest, plus she gave you $100,000 back. You put your $100,000 back into your insurance policy, and what did you just make? You paid 4% to yourself because you put it back. So you just earned 4%, and you made an extra 10% on that same $100,000. You tell me, does that sound like a scam to you?
Not at all. Not at all. Not at all.
So
Yeah, I
you
mean
bring
that's something that we need to be more open to, because here again we're becoming our own banker by
Yes.
doing this, using funds that we've accumulated over a number of years. And I assume, you could, like you said, you can still borrow that money to do something other than investing, buy yourself a car or put a down payment on a house or whatever, as long as you pay it back, which seems to
Yes,
be
man.
the key. Yeah.
Yeah.
Yeah. Because
Pay
you
it
can
back.
continue to do it if you pay it back.
And now, if you don't spend that 10,000 in interest you just made, you loan that out too. Now you loan out 110.
Now
So
you're on a roll. Mm-hmm.
now you're on a roll. You find
Mm-hmm.
somebody to do that for every 4 times a year. That's a 40% return, and you're in control of the terms. You're in control of the conditions. You're in control of the property. We can talk more about that on other episodes, but I think it's
Yeah.
something that we should open up to our audience and listeners and explore those possibilities because they're out there.
Yeah. 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 Well, great. Here again, a reminder, you've been listening to the Crotchety Old Men podcast. Another great subject talking about life insurance. Continue to tune in, continue to download the different episodes. We're now in the season 2. So, we're going to continue to bring you information, education, kind of expose you to different things financially wise. So continue to watch it. You can download us on Google, iHeart, and like I said, wherever you get your favorite podcast from. So, Gary, in closing, you got anything for our audience?
Well, absolutely. And here we go. I just had it in front of me, but I'm a real estate guy. And so when I look at real estate, as far as I'm concerned, real estate is the best investment, right? So here's the quote from Gary L. Smith. The best real estate investment you will ever make is the real estate between your ears.
There you go. Knowledge is power. And now you know.
Now you know. Peace.
Peace.